130 odd point cut right now once again. IEX, of course, is the big mover. Maybe just look at Coforge as well. Is there more pressure, or has it stabilized? Because it's like a one-way disaster. It's up about 10 bucks, so 16.90 or so on Coforge. Harish Krishnan is with us. He's a market master of the day, co-CIO, head of equity at Aditya BirlaSun Life Asset Management Company. Harish, good to have you with us here. This drift in the US, it's a drift higher. In India, it's just a drift. What's responsible, Harish? Is it muted earnings? But muted earnings were very well advertised, nothing surprising, right? There's hope for H2, but it's hope till it's realized. So what's going on?
I loved your phrase, Prashant, drift. The way we say it, it's a grinding bull market. There isn't...
there is a grind, sure, but the bull market is, but maybe it's there, right? We came off a very good phase, admittedly, absolutely. Go on, Harish.
Right. So, clearly, I think the directional element of earnings, the directional element of liquidity and sentiment are all turning positive, and the rate of change is there. The question is only about valuations and have we gone too far too soon? And also the fact that there is such an enormous amount of supply that at each 2-3% higher levels of the market, you see the next wave of supply coming through. So therefore, we have to climb both these walls. So the way we think about it is that the lows of the year are made. But if we were to plot, say, the top 1,000 companies' profits and the top 1,000 companies' market cap, and it's a pretty interesting chart if you were to plot it over 25 years, they broadly move together, which is how it should be. Markets are slaves of earnings after all. Sometime in March of last year, March of 24, we saw a very big divergence happening where earnings growth slowed down quite substantially and the market cap continued to keep going higher. And we saw a lot of that froth get cleaned up by February of this year, which is when we turned reasonably very positive on markets. Since then, this rally that we've seen in the last 3-4 months, we've kind of got back to 80% of that divergence again. So in that sense, I would say that, we now need to see earnings coming through. There isn't too much of comfort in terms of valuations. And therefore, my best guess would be that there would be a time correction. Let the earnings come through over the next 6 months and then to see the next move up.
Harish, hi, great to have you on the show this morning. So, yeah, red screens, that's what we're seeing. So, the problem is, Harish, now you don't know what is the safe haven or what is that area where relatively you'll be better off. You park your money there at least for a year and you'll be fine because IT is not working. FMCG seems patchy, and especially first quarter earnings reactions have been sharp. Look at Nestle, look at Colgate. Anyway, the growth, is not expected to be very, very strong growth. And then there are financials where there are these off and on issues coming up, asset quality, credit costs, some margin compression. So where do you go?
So I think we've had this view that, the leaders of the next bull market over the next 3-5 years are going to be very different from what has kind of taken the market over the last 3-5 years. And therefore, we kind of outlined that there are 9 sectors where we think the potential leaders could emerge. I'm not saying that all these 9 could end up being the champions of the next bull market, but there is greater margin of safety, let me put it that way. Now, these include sectors, including private sector banks. I know financials is a broad spectrum where NBFCs have done a lot in the last 3-5 years, but private sector banks have really taken it on the chin, given significant regulatory kind of oversight that kind of was getting there, right? So we think that private sector banks could be potentially one such area. Similarly, we think that, both cement and metals, which we've been consistently maintaining as our dark horse sectors, continue to do quite well. In fact, cement earnings have kind of surprised quite positively, and they've also kind of performed quite well as the consolidation of the overall sector kind of takes place. Also, the fact that cement is a huge consumer of energy, and with energy prices down, we do think that a larger portion of that profit can potentially come to the shareholders eventually. The other sectors that I would think one should possibly look at would be sectors like, say, insurance, metals, oil and gas, FMCG. yes, it's not a complete swathe wherein we are getting everything decked up, saying that consumption is revival is back. But if you look at the Amazon Prime data points that came out over the course of the last week or so, we've seen some encouraging demand momentum coming through as far as urban India is concerned. So I would think that there are bits and pockets. Yes, will they work in the next 1 year? Quite honestly, we don't manage only for the next 6 months or for the next 1 year. Our endeavor is to manage the experience of our unit holders as well as identify potential sectors where we can deploy reasonably large sums of money.
Harish, I've been sitting with my notepad and I counted 6. Private banks, cement, metals, insurance, oil and gas, FMCG. Anything you're missing? Because you said 9.
Yeah. So
in case you remember.
Yeah. So there is alcobev.
Okay.
There is chemicals. That's the other sector. And then a very small sector like textiles. So these are the 9 sectors which, in our opinion, there is some margin of safety. Again, it's disputable, and one can always say, where really the value lies.
There was a big alcobev deal that was announced, Harish. What do you make of that? This space was not seeing too much of inorganic growth, at least for the last 10 years since that United Spirits Diageo deal took place. But all of a sudden, you have a $500 million deal. What do you make of it?
I think it's an exciting area. I think broadly there are 2 points. One is that during COVID, given the commodity price increases, almost all alcobev companies saw significant margin contraction. And given the fact that they are mostly regulated in almost all states, price increases have been patchy. We are now at the other side of the curve, wherein you are seeing a deflating commodity cycle, especially for some of the bev kind of raw materials, and you're seeing some amount of price increases. In terms of competition, yes, I think from the bastion of MNC kind of dominating the alcobev, I think we are seeing some Indian origin players starting to really kind of come through. I think India is a very complex market. A lot of regulations, as a CEO of a brewery recently told us, operating in India is like operating in the European Union. And therefore, it does take a significant amount of regulatory kind of bandwidth to kind of operate in India, for which many Indian players are far more nimble and adept at. So I guess some of this is something that we will be looking for in terms of how large the competitive activity kind of shapes up. For now, we are happy. Just to kind of bring you one point which is in the back of our mind, even though we are currently positive on alcobev, I think we really have to watch out for what happens when GLP-1 really kicks off in India and its impact on the craving industry. It's a massive experiment globally that is happening, wherein almost in about 100 countries, this drug is going to get generic. The impact of what it happens and its after effects on consumption, I think it's still too early for us to kind of look at. But at the back of our minds, we are definitely kind of watching out as to how multiples will move for this sector once GLP-1 kind of takes off.
I'm going to pour you the drink and I'm going to give you the medicine.
In the medicine, I was wondering, wow, what a connect, Harish. That's
nicely. Just joking, Harish. But that's an opportunity. Absolutely. IEX, just using that as a case study, not your view or whether, I mean, if you want to talk about the name itself, please do. But it's limit up 10%. It's a number 1 volume traded name on the NSE right now. What's your sense, Harish? We, by the way, have the management joining us a little later. But how are you looking at this one? And what has transpired here?
So, Prashant, unfortunately, we can't really speak on stock-specific developments. But I think platform-led businesses inherently, are loved because of their monopoly/duopoly kind of structure, wherein winner takes all. Any kind of development which kind of impinges on this duopoly or a monopoly kind of a status, while earnings, etc., will see a lesser of an impact. The question really is what really one should give as a multiple for the future set of cash flow streams. I mean, I don't need to tell you that in any company, almost 80 or 90% of the value of the company resides in the terminal value. Terminal value is anything which is beyond the next 5 years. And therefore, when the terminal value of such an enterprise is so nebulous, wherein we don't know from the current 90% share, would it come down to 30 or 40 or 50%? It's all, balls up in the air to try and create, probability scenarios. But I would think that, there are other plays which are monopolistic, which we kind of invest in. We will kind of assess all of such opportunities as they come.
Sure. Harish, very quickly, let's talk about the good things, at least of this week. And the good thing of this week was definitely eternal, right? So I know you won't talk about the stock per se, but the big debate is whether the worst is over for quick commerce and these, food delivery platform businesses. Where do you stand on the debate?
So I think the competitive rationality is kind of starting to come through, especially as the third player also wants to get listed. I think there is going to be generally a discipline that needs to be showed for the profitability metrics to come through. The question that we kind of crystal ball gaze through is primarily about the potential TAM of this market, and that is where I guess the bigger debate for us is. Clearly, in the urban centers, the top 20 cities, quick commerce is doing exceedingly well. It's cannibalized a lot of other retail outlets. But can it thrive in tier 2, tier 3, tier 4 with lesser urban density, etc., is something I think that the jury is still out. And that will have, I think, a far greater bearing. Because again, like I said, these are all 3 lakh, 4 lakh, or 4 lakh crores in aggregate market cap entities. Almost everything is terminal value because near term is all loss making. And therefore, how this changes in 3 years will have a far greater bearing than where we are. For now, we continue to have ownership in these names.
Okay. All right. Got it, Harish. Thank you for the perspective this morning. Great conversation. Wish you a good Friday and have a good weekend as well.